What is blockchain?
What is blockchain? Well, that's a difficult question, isn't it? Because, a digital ledger is the fewest amount of words that people use to describe it, isn't it? But that, to me, that doesn't mean anything unless I know. I understand what it is now, but I think if you said that to me when I first heard about it, I wouldn't know what you meant. Because
it's, I guess my simplest explanation is a shared database, but it's got the hash, which confirms that it hasn't changed. And the simplest explanation for the hash that I've given out is, a Visa number has 16 numbers, and the last few are just sum of the previous numbers.
Right.
So if you screw up one of the numbers, that last number is a checksum, and the checksum confirms that no, this is or is not a valid Visa or MasterCard number.
Okay.
And so that's one explanation I've given to people, but
yeah,
the whole math behind the hash is way more complicated than just adding up a bunch of numbers and saying yes, it's a good total.
Yeah,
just a little, but essentially it's a really good explanation. I think the distributed ledger technology is just it's a technology that gives people the means to have unintermediated transactions, meaning they don't need a third party to take note of the transaction. So you eliminate that need of having somebody that's holding the one and only book that compiles all the transactions.
Right.
And in the case of blockchain, if we're all participating, we all have Bitcoin, we essentially have our own copy of the ledger, of the book, which is that distributed database.
Yeah.
And you don't need to trust anybody else but ourselves. We trust each other to do the transaction, to move money across between each other because we can see the record of each transaction happen.
Yeah.
I think that's another way to look at it.
Yeah. There is the detailed problem that us looking at it, like there's going to be a super technologist who can go through and look at each line and confirm each transaction. But a common person who's on the blockchain and using digital currencies, they just trust and hope that someone else is looking at that ledger confirming it.
The same way that we do now, right? I don't know what's going on with my money, but I put it in the bank. I put it in a mutual fund or whatever. And I'll just leave it there.
So we trust the banks right now, but with blockchain, we trust the technologists who are enabling blockchain. Because if you do it yourself, you have to have a lot of technical knowledge to actually confirm that, yes, this block has not changed.
Mm-hmm.
It's
kind of
a lot of trust in the apps like Coinbase or any of the digital wallets that people put their money into. You've got to trust that digital wallet.
Yeah. I used Coinbase. The first time I spoke to you guys, I was asking, shall I invest in Bitcoin? And I did put a little bit in, and now it's doubled in like the few months that I've been in there, which is insane. But then I have a friend who I talked to about Bitcoin and this kind of stuff, and he said don't use Coinbase because didn't they have some kind of problem where it just all crashed for a few seconds and there was millions of.
Well, there's a few exchanges. The most recent one, if I remember correctly, was Kraken, which had one cryptocurrency where there was a sort of flash crash of the value, and it was local to that exchange.
Yeah.
But essentially, exchanges are private entities, right? They're probably the early Wild West version of banks. Mm-hmm. So you entrusting them with your money, which is essentially what you're doing when you're giving them crypto money and you're leaving it there. It's kind of like saying, I'm going to trust this private bank to hold it for me.
Yeah.
And you may not have their address if you're not paying attention. You may not know where they are. There's no building. There's no people you can go to blame. Sometimes they're in a different, geographical location, which also implies that maybe legally you may not have as much recourse as you would have had if the bank would have been here. This said, I totally agree. It's all about trust, right? Either you have your own application wallet, or hardware or software wallet, and then you manage that, but then you have to trust the technologist that wrote the application, or trust the company that made the hardware wallet, or you start your own Geth client on your computer, which is the lowest level of getting a node running on let's say on Ethereum as an example, but you could do the same thing on Bitcoin. then you manage everything from bottom up.
Mm-hmm.
But then that means you're kind of pretty smart in software, and it's got a lot of implication with regards to your ability on a technological side.
Yeah.
So trust is always going to be an issue, but I think it's an issue in the classical system, right? We trust banks, and we brought a lot of interesting notes here that represent, economies that may or may not have run so well at some point or other. So devaluation, or banks closing, or currencies like the mark disappearing is similar to what might happen in a cryptocurrency environment where an exchange closes and all of a sudden you have not so many recourses to get your money back.
Mm-hmm.
On the bright side, historically there's empty GOCs that actually got, the foreclosed, and there was a big scandal about it, and a lot of people lost funds. But basically, the debt was bought off by one of the large exchanges that exists right now, and people are getting partially refunded for those losses.
Yeah.
So the economy is building up around what we need to.
Yeah, and the DAO, the distributed.
That's
I actually invested like a small amount. I just wanted to see how difficult the process was, and it was horrendously difficult.
Right.
Like buying the cryptocurrency, converting it to the one they wanted, submitting it to the system. The usability of these systems is very bad.
Right.
It's getting better. Yeah, it's getting better. It's getting better. But I wanted to see how it went, and so I was invested in the DAO, and it's like, wow, that was a massive amount of effort to get into that. And then when it was hacked, and everybody kind of went, oh, it's crashing, and eventually I got all my money back. So it was just the patience and everybody going through, and it just came out, and I was refunded, and I got my Ethereum, and it was worth more at that point, but still it's an interesting kind of accountability, because it's like open source software, where banks are not open source. Like banks are completely opaque. It's an application on your desktop that you can't see the code. Whereas open source software, the layperson who kind of says, well, it's open source, hopefully someone else is looking at it and making sure that it's running properly. Mm-hmm. And anybody with the technical know-how can do that. The network effect, though, is interesting. Like, currency for countries comes and goes based on the country, but currencies and cryptocurrencies, digital systems can just appear and disappear, and the popularity of it.
Yeah.
So Facebook, it's network effect.
Yeah.
MySpace is just fading to nothing, and Facebook is just exploding. But now Snapchat is growing, and Facebook is for old people, which is very weird. Like it's not that old, but like young kids don't use it, and as soon as those young kids become adults, it's all Snapchat, and Facebook is going to become the MySpace of our generation.
So basically, what you're saying is like something like Bitcoin or Ethereum, for it to really kind of have an influence, it's going to have enough people going over to it, rather than the herd has to be there, right?
And that's where, when you have other things besides currency, because if you have currency on it, as soon as it starts fading, the value is going to drop, and it'll just go to zero very quickly.
Yeah.
But something like identity or other things that are on the blockchain, like your school records, your employment records. There's people putting those things on the blockchain to certify them.
Yeah.
If nodes start disappearing and the blockchain kind of fades out and there's only a few nodes left, it gets more and more difficult to confirm that what you put on the blockchain is still there.
Right.
Because that network effect fades out, and so eventually it just disappears. And
maybe we should go back to the start, because I know that Bitcoin, there was like a mysterious Japanese guy who invented Bitcoin, right? Is it the same person who invented blockchain, or was that someone else?
Did they ever resolve that?
No. So the first white paper that came out about Bitcoin was by Satoshi Nakamoto, which is a pseudonym one or many people.
Okay.
So we don't really know if it's a group or if it's an individual. Most experts that have made statements about this think that it's more likely a research group that took a lot of work that was they came out of the 70s and the 80s on cryptocurrency, encryption, electronic money, and basically combined everything and came up with a sort of incremental improvement on a lot of this research, and put together something that was meaningful around distributed ledger technology. Essentially, it's public-private key pairs with this notion of blockchain, which is the distributed ledger or a linked list of blocks that contain transactions, the signing using elliptic curve mathematics, to essentially bring together a whole package, a protocol, if you will, that makes sense to have decentralized electronic cash without an intermediary. So Satoshi Nakamoto is a name that signed a paper that was distributed in a user group. Yeah. And people reviewed it, thought it was a good idea. I read it back in 2009, 2010, and it started, being implemented. Some people actually wrote the first client and distributed it. People started writing it, mining Bitcoin. Yeah. And, blocks. And I think at the beginning there was a certain period where the Satoshi Nakamoto individual or group kept communicating with a number of fairly prominent individuals in the Bitcoin community and participated in the initial mining and the initial implementation, but he disappeared over time. And now the network runs by itself with no real originator, at least known real originator. Right. That's kind of...
Yeah, and is it surviving off the fact that so many people see the potential in it? Is that what's keeping it going?
Well,
the idea is so strong.
There's more than $150 billion US dollars of worth right now in the network. So it's a little bit, I think, just by the fact that people have this real trust. I mean, when you're putting real money, you're entrusting this network with your, at least from my perception.
Yeah, I worry about those, the value that's put on it, because it's really the transaction volume in the last day or the last couple of weeks and what people are willing to exchange in US dollars for cryptocurrency. That transaction volume recently isn't reflective of what is available entirely through the all of the currency. Like there's large blocks of Bitcoins that aren't trading. They're just sitting there, like really old mined blocks that are just dormant.
Of course.
And are people sitting on that and waiting? Because that's worth, I don't know how many millions of dollars, but some of these accounts are just dead account, and there's millions of dollars in those that aren't moving.
Well, there's Satoshi Nakamoto's blocks are frozen, right? So obviously he was a participant in your Bitcoin network, and none of his blocks have been cashed in. So essentially there's this dormant, enormous amount of money, I don't know the number exactly, that's sitting there linked to a public key that points to him. Right? Yeah. And nobody's claimed that money.
Right. So I guess this brings us to the next big question is, when are people actually really seriously start using things like Bitcoin as like a way to trade things in the real world, right?
Well, it's already happening. Yeah. I mean, there's lots of organizations that are currently providing services that allow you to do cross-border payment using cryptocurrencies because it has certain advantages over cash. Right? Yeah. Depending on the legal context and the legal framework you're working with, these companies allow somebody that's located in a country where it may be not an easy feat to move a certain currency from that location to where they're located. So the company will basically allow this trade to happen very easily using cryptocurrency. It's real business, and it's happening at the Fortune 500 level. Yeah. So I think one of the misconceptions is that Bitcoin or other cryptocurrencies are strictly for speculation. I mean, there's a lot of speculation going on, but there's also support right now for commercial endeavors. And anecdotally, I joined this site where you can pick freelancer jobs and get paid. I did that a few months ago just to test it out, and in my own time at home, I wrote a little article, said that it got paid 5 ethers for it. And 1 ether was worth almost nothing.
Yeah.
And today an ether is like 340 US per ether. So you get it. Of course, there's speculation in me working, accepting the ether, but the transactions are happening. People are paying with cryptocurrency.
Mm-hmm.
I think a lot of the value is driven by gaps in the legislation and government being slow, though. Because just recently, like the value of several of the popular cryptocurrencies just dropped.
Yeah.
And it was because China cracked down and said, hey, we're cracking down on cryptocurrencies. And then recently it's gone back up and it's gone further. But that's because China is like now giving signals that, okay, maybe we're going to allow some cryptocurrencies. So the demands of the currency are how lenient or strict the government is in controlling it.
Yeah.
So the participation of big business is that we're allowed to because the government hasn't made any legislation that says we're not. So like Brazil is the.
I agree and I disagree with that statement. And that I think it's at the moment and in the past few months, or past year, it was the environment's so great in terms of legality, in terms of say governance, that you're always walking a fine line between what's legal, what's not legal, and what really is cryptocurrency. I mean, we don't really know. Is it an asset? Is it a currency? And just last week there was a great meeting at the SEC. Where a few big proponents and some big groups went and presented, their ideas about cryptocurrency, and one of the big statements was, essentially, cryptocurrencies aren't really currencies; they're more like assets, and it means that this is a debate that's not solved yet in countries like the U.S., where we're probably at the forefront of use in terms of cryptocurrency. But legalizing, putting a framework on it, having governance is important. It's going to be critical to the advancement and back to the question you said, what's going to make it what's the change that's going to make cryptocurrencies the killer app or make us use it? Well, I think it's proper governance. It's the government's coming in, putting real legal frameworks around how you use cryptocurrencies, what's needed, without killing them, right?
Yeah.
Obviously. But putting a framework such that it's easier and it's clearer what happens. I think Quebec is a good example of that. The AMF actually created a framework to support companies that issue their own tokens over cryptocurrencies or over cryptocurrency technologies such as Ethereum. So here in Quebec, if you want to have your own ICO, initial token offering, or coin offering if you use ICO,
right.
You go to the AMF, they have a framework for you, they put you in this little box where you're legally protected and you can have your ICO. And that's a really great thing because it gives a chance for the people who are doing it to have a reference to the old market and how things are done and how you protect your customers. It also gives the government and the authorities a chance to look at these entities that are creating this and to understand how to better frame them so that you protect the end user, you protect the customer. That's what we want, right?
Yeah.
You don't want to lose your money when it's in Coinbase. You want to keep it.
Yeah.
Even if there's the speculation, when it goes up and down, the risks that are standard risks. But you don't want to deal with non-standard risks, like Coinbase saying, oh, we don't exist tomorrow and all your coin belong to us.
Yeah.
You don't want that. But if you have Bitcoin and if Bitcoin drops 20%, I think you understand that it's part of the risk, right, as an investor. But that's so that's where I think we need more governance so that the government protects you when you have your money in Coinbase. There's a certain amount of guarantee. Personally, I see the banks taking, having a responsibility here to sort of understand what these types of assets are and provide the same or similar guarantees they do with normal currencies or normal assets of this type.
Right.
If you deposit your money in the bank, right, they protect your money. Well, the government protects your money up to a certain amount, and the banks are, forced to abide by certain rules and regulations so you're protected.
Mhm.
Well, if cryptocurrencies are a similar type of asset, why don't banks have the responsibility to at least manage, or the capability to manage these types of assets for you? Maybe you trust one bank over another more than you would Coinbase or some private company in Timbuktu.
Yeah.
Anyway.
Yeah, one of the interesting things I heard, and I didn't confirm it, but the walking across the border, if you're carrying more than $10,000 in cash, you've got to declare it. Any kind of assets like that you're walking across the border with. They're now looking at if you have cryptocurrency valued in that range, you also need to declare it.
Right.
Because if you walk into the country with nothing, and then you go to a bank, the bank has all the anti-money laundering, making sure that terrorists
know
your customer. All those rules that are preventing certain transactions from happening. The bank is there to stop that. But if you walk into the country with nothing and then have access to the cryptocurrency passwords, all your money gets into the country without anybody seeing it or knowing it.
Yeah.
And then you can just walk into a bank and say, hey, I've got this money from my friend here who bought all my cryptocurrency.
Mm-hmm.
Yeah. So this is a U.S. regulation, if I remember right. It's also something I heard. It's imposed on U.S. citizens. So if you're a U.S. citizen and you're walking across the border and you're not declaring that you have more than $10,000 in cash, then it's the same rule that applies if you had like $1,000. If you have 10,000 and more in cryptocurrency, it's the same rule as if you're walking through with 10,000 and more in cash.
Right.
So there's a perception. I think governments are realizing what this technology is, and regulation. This type of regulation for me is it's a step in the right direction. It means that we're sort of understanding what it is.
Mm-hmm.
My take on this is people are afraid because there's no real definition.
Yeah.
And there's no frame. So if you buy cryptocurrency, well, who knows? Maybe you can't use it tomorrow because the government says you can't use it.
Yeah, yeah. Because it's too much to expect. People who maybe like more libertarian. I can imagine in this kind of utopia where we kind of just break down the banks and everything, but it's not going to happen, right?
No.
So that for a sensible person, that regulation is a sign that yes, this is really happening. It's going to be a much more efficient system.
Of course.
Yeah.
Yeah. The people organize and always get into groups to get better security.
Yeah.
And a bank allows that to happen, that there's a group that is going to look after your money and make sure you don't lose it.
Mm-hmm.
So whether it's a bank or a cryptocurrency exchange, there's also a level above that the government insures the bank and says, hey, if you have this much money in an account and the bank screws up, we'll cover you.
Yeah.
But for cryptocurrency exchanges, that's not there.
It doesn't exist at all.
Yeah.
So yeah, and also to kind of get cryptocurrency to be mainstream, it would be a government saying, hey, you can pay the taxes.
Well,
and then it's like, that's the government saying, yes, we're going to be doing this.
Yeah.
We're all more or less crypto investors. We've all done a little bit. James, I think, ran his own mining operation to experiment. I bought some cryptocurrency to experiment to see where it would go. You tried it yourself. But we're talking as people who have a bit of knowledge about this. Now,
I'm very interested in it too. Right?
Yeah. And your question about how cryptocurrencies are becoming mainstream, for me, goes up now to the level that we're talking about. It's the entities that are actually really pushing this and really looking at the problem are a lot slower cognitively, in my point of view. And they're got, and I say slower not in a pejorative way, but they're systems, right? Governments are systems. So we are looking at it as individuals. Companies started looking at it and doing stuff. The exchanges are approved. The companies that are now accepting Bitcoin. I mean, you have lots of companies out there that accept coin or Bitcoin cryptocurrencies as payment. Governments are, I think, almost the last front where this thought process needs to happen, where this consideration of cryptocurrency needs to happen. And what I've been reading is it's a race. It's not how are they going to ban it or or they're not thinking about it, or not considering it. There's a race to really learn how to adopt cryptocurrency properly. So you become the first country where these economies are going to thrive.
Right.
So Estonia, right, or some of the other technological havens or fiscal havens are already thinking, hey, this is the best way for business to be able to transact simply without having to look at traditional currencies as the crux of the issue. Now they're like, well, let's move everything to cryptocurrency. It's a little bit faster. Moving money out of a geography into ours is going to be much simpler. We don't have to rely on old infrastructures and the traditional third party that was sometimes slowing down this process. So it makes a country like Estonia become much more competitive at a global scale when you think all of a sudden you can move millions of dollars into Estonia, into a business that's legitimate, that does great work, pay your taxes, be an electronic citizen in Estonia without having the burden of relying on some of the other entities that might have slowed down that process, right? So I think the reason the EMF and Quebec are accepting ICOs and these entities is because they're racing as well to understand it better, to use it better for us to become competitive on the world stage economically, and at least with regards to this technology.
Right. So when you mentioned Estonia, was that just a random example, or is that a country that's doing this? And why Estonia?
Estonia is probably the most advanced IT country in the world.
Why is that?
They instated a program for electronic citizenship. They simplified the process of creating startups. They're actually trying to adopt and I think they've already adopted their own local electronic currency in order to support that process.
Wow.
I think, obviously, Estonia is a country where you have a bunch of very well-educated people who came out of a regime that was a little bit frozen in time for a while.
Right.
But turned it around for themselves and did something extremely extraordinary by trying to become a global powerhouse in IT. And due to their geographical location, it might have been, they're not next to California. So it's a little harder to import brain power and to import the technologies. So they said, let's instate some framework and a space that allows or that simplifies this migration of interest into our country.
Right.
So instead of doing physically, you do it electronically. You do it on the net, right? So I'm an electronic citizen of Estonia. If I apply for this electronic citizenship, and then with this, I can have my own business there. I can pay my taxes there as a business. It becomes a way for non-geographically based citizenship to happen, and then the cryptocurrency fits super well in this frame, right? Because it's boundless. Crossing borders with cryptocurrencies is not really something that happens. You're right. Technically, of course, today you may be legally bound to declare it in the U.S.
And it's the cryptocurrency that's exchanged, but it's what are you giving up for it?
Right.
So the value that it's set at is the last exchange that happened. Who bought cryptocurrency for US dollars? Who bought cryptocurrency for European dollar or euros? There are other exchanges going on that you embed a house or a mortgage or a gold deposit certificate into a specific type of coin that you can then transfer to someone and say, now you own the house. Right. So inside that is an encrypted certificate that says whoever holds this token now holds the house, holds the gold deposit certificate. And that kind of transfers value that's beyond just buying and selling Bitcoin on exchanges.
Yeah, that's an even bigger conversation.
Yeah. And so that's interesting because Estonia is using your identity can be on the blockchain.
Right.
So your your face, your social insurance number. I'm not exactly sure how it works, but that identity is certified on the block, and the next block comes in and there's new people added to the roster. That's where a shared database, the blockchain that underlies all the currencies, can be used in other ways beyond just exchanging tokens.
Yeah, because blockchain, obviously, it was created, with the Bitcoin and cryptocurrencies in mind, right? And then, but now people are saying, okay, well, we can do all these other things with it, right? Supply chain and identity management. And so what was the power in that idea of the blockchain? Was it just because the technology advanced to the point where this concept was possible and it was easy to kind of come up with it, or is it just a really powerful invention?
I think the shared database voting and other things were there as concepts before, but now there's a huge infrastructure available.
Right.
Like the number of nodes that are mining Bitcoin and mining the transactions or validating the blocks, it's huge. NVIDIA, the video graphics card company, like their stock has gone up amazing amounts because all of those cards are being bought and
support the mining.
So that infrastructure is now out there and is built and can be used beyond mining Bitcoin. It can be used for some other things, but as the blockchain can be repurposed to other means.
The blockchain is not just one blockchain. There are like many blockchains. So why do we call it blockchains? Why is it blockchain?
That's technology, right?
Blockchain technology with multiple blockchains. There was the split in Bitcoin into Bitcoin
forks.
So what was that for? Because I heard about it, but I didn't know what was happening. All I saw is I got some extra money.
I think it was they were trying to ease the processing. I'm just trying to
there's many forks
right.
and many cryptocurrencies. So we'll just use the most recent one with regards to Bitcoin, which yielded Bitcoin Cash. So there's two things, right? You ask a really interesting question. There's the technology, which we call blockchain, and there's the data structure that is a blockchain. So the blockchain technology is really, I think the term that's mostly used in technical circles is distributed ledger technology, which is a nice way to say blockchain, but you're kind of pointing to the fact that you're saying, I'm talking about the technology, not a blockchain. So if you want to say blockchain is a technology, you could say DLT. A blockchain is just an implementation or a living data structure that contains the transactions in the blocks. So you've got the Ethereum, and you've got more than one. You've got 2 Ethereum blockchains that are running right now that are public.
Right.
And there's probably a slew of private blockchains that exist for various reasons. There's the Bitcoin, the 2 Bitcoin, the 2 main Bitcoin.
So that's what the fork was. It was becoming 2 different blockchains.
Well, it wasn't a choice. So again, that's the funny thing about this, right? So when a whole bunch of people decide to implement a blockchain, so they all get together and they connect their nodes together. And let's say you're about 6,000 nodes, and you're all running the same version of the software, and instead of saying the software, you're running the same protocol. You all agree on the way things are happening. And in Bitcoin, there's a number of transactions that's accepted every few minutes.
Right.
Okay, and it becomes part of a block, you sign it, and then the transaction's confirmed on one block, and for real confirmation, you wait for a number of blocks to be confirmed. So you have a stack, and your transaction's like maybe the 6th block, then they're the top of the stack, and you're fairly sure, that this branch is good and that your transaction's confirmed. So you received $1,000 from me after 6 blocks being confirmed. I can't double spend that $1,000. It's going to be extremely hard. Okay. Let's say we decide, or part of the people who are members of this network, this community that runs all the same nodes, think the rules aren't fair, or they want to change something. For example, they want more transactions to be confirmed per 10 minutes, because the network's getting a little bit slow, it's harder to get your transaction confirmed, or it's more expensive. So people say, hey, why don't we have this new protocol, or we change the protocol so that instead of accepting 1,000 transactions on a block, we accept 2,000 or 4 or 5 or 6, whatever.
Okay.
Well, you need to change the protocol and everybody needs to agree. If not everybody agrees, then you have a fork.
Mm.
One of two things can happen in a fork. The people who were the old guard keep their network running, and the nodes still are alive, and there's still this real exchange happening. And the ones with the new versions start their own, and they keep running. Now, because you have two copies of the same data structure, essentially it's Bitcoin version 2, you have all the same, let's say, balances of accounts.
Right.
Your account exists now in two worlds, or in two networks. So you doubled your money.
Mm-hmm.
Now, in the real world, when you're looking at these two separate blockchains, I'm still talking about scenario 1.
Yeah.
Okay.
Yeah.
Your money value of a cryptocurrency depends on its accessibility.
Right.
Meaning, your only way to buy Bitcoin is to go through an exchange or an entity that will sell it to you. So somebody that's able to go on that blockchain and trade cash for coin. If the exchanges decide to list the new chain, then you have a real fork that's really accessible, and the new currency is available for trading on these exchanges. Obviously, this is more or less informal. It's not like the exchanges all get together, vote on one day to say, okay, we'll accept Bitcoin Cash.
Right.
Maybe one exchange decides, you know what, we'll list it, and everybody who wants to buy it buys it. And everybody goes to the one exchange, buys Bitcoin Cash, and then the value goes up or down, depending. So it's really a question of offer and demand. If the new chain dies out, it just disappears, it fizzles out, then the old chain is going to remain. And the reverse is true too.
Mm-hmm.
Now in the split, if there wasn't enough strength by the new group, then what usually is going to happen is they're going to disappear and there's not going to be a real fork. Ethereum just forked today.
Right.
For example, went into the Byzantine version. There wasn't the hard fork, didn't allow for new Ethereum Classic 2 to pop up because there's no real willpower behind it. Okay. But if there was, then the discussion would be different. There was a case, for example, about a year ago where Ethereum split, and there was enough strength behind some of the old node holders to keep it running, such that a new currency appeared called Ethereum Classic.
Mm-hmm.
But,
Yeah.
when you're looking at forks, this is what's happening. It's just people getting together, communities deciding whether or not to run the nodes, and then some exchange deciding whether they'll list the new currency or the separate currency again. What physically happens is you have two copies of the same balance on different blockchains.
Right. Okay. But you see this as something that's kind of going to figure itself out over time, and it will have to. Yeah.
Well, it's a natural thing. It's a scary thing about blockchains. You have to realize nobody can regulate this.
Yeah.
Because it just happens.
Mm-hmm.
That's where the private blockchains come in, because Project Jasper, the Canadian banks that wanted to do the exchange and got what was the group, the
R3?
R3 group.
Yeah.
They were looking at that and looking at the processing, and one of their problems was finality. Like in central banking, when it's like one large bank setting a transfer to another large bank and the central bank's involved, there's finality. It's like the exchange has happened.
Right.
On blockchain, like what you said, they're waiting for like 6 blocks to go by before they say yes, the transaction has happened, because there's possibilities of something being fake, and so finality on the blockchain is vague.
Right.
Like, why is it 6 blocks that they're waiting and not 12 blocks? Like, is it probabilistic? And then when a fork happens, a central bank would just like the monetary system is like, oh, we've just doubled the amount of money available. That would really screw with inflation in a country. On blockchain, it's
It's a process that's not controlled, right? Mm-hmm. So in central banking, you have these fairly tight controls on how money is issued. It's not, and it's a means for, let's say, the authorities to ensure that our economic system stays relatively stable.
Mm-hmm.
That guarantee's not there in cryptocurrency.
Right.
There's no such guarantee of stability. It's just a very kind of libertarian, free-for-all market. Right?
Yeah.
And you have to be aware of that, of the nature of that market.
Yeah.
I think the stability is innate, personally. That's my point of view, in that it relies on the network investment, right? So Bitcoin's relatively stable, I'll say, because everybody's invested in it and the economy's invested in using it. It's going to remain stable because of that. But there's not too many levers you can pull or push. You know, the thing that can modify Bitcoin value is a large group trying to disrupt purposefully its value. Meaning, if somebody's got, I don't know, $50 billion to spare, and they really want to influence the value of Bitcoin, well, they go in and they do either a large buy or a large sell, and then all of a sudden you'll see movements in the market. But it's kind of natural with respect to what you'd see in an economy, right? It's not interest rates going up or down. It's really, this lever it's a market lever. If you want to disrupt the market for 50 billion's worth, you're going to have to take your 50 billion, go in, invest it. And if you feel like losing it or losing the value of your 50 billion, you're going to have to dump it and see the market drop.
Yeah.
But you're also going to be a victim of what you're doing. That's the strength of blockchain and this decentralized technology. There's a cost to you attacking that network, whether it's using real currency or not.
New players, though. The original players, Satoshi, like those large sums that.
Yeah, Satoshi's dangerous. It would be dangerous. You can see a large dump there. Yeah.
The guy who bought the pizza, the first transaction.
Domino's pizza.
Yeah, he bought a pizza and it's worth, I can't remember how many millions of dollars nowadays.
Yeah.
But those small accounts back then are now huge accounts and can be disruptive if someone says, I'm selling, I want my money out.
Right. Because this, one thing I do wonder about is I don't know if you can generalise, but what kind of person does it tend to be who has influence in these communities? Like, who are the people who are kind of the big influences in deciding the forks? And
it's the huge mining pools, I would say.
Depends. I think the huge mining pools. So the miners are very strong, especially on Bitcoin, right? Because Bitcoin doesn't have this. We'll talk about something else later, but essentially, for those who don't know what mining is on cryptocurrencies, mining is the way you secure the block that contains the list of transactions that happen within 10 minutes. And this signing is secure enough so it's hard to unsign and to re-sign, so to break the network. It's a way to ensure security, basically, of the transaction.
And the miners receive a reward for doing that.
Exactly.
And that's where new coins are issued.
But this mining process is very costly in terms of energy. Essentially, as James was saying, people use these monster machines that are either completely dedicated to doing this, meaning the chips are designed to do this, or they use video cards to do it and stuff like that. Now, the video card example is not super valid anymore in Bitcoin. Works on Ethereum or some other smaller networks. But essentially, the mining itself is causing, say, these economies to kind of be geared towards these people being the deciders of where the networks are going to go, because they're so heavily invested.
And is it voting per node on I guess that it's because when the new protocol comes out, whoever starts mining that. So
exactly,
all of your switch, you just say, well, I'm mining this versus I'm mining that. And that's kind of the vote.
So is it possible that we could have a situation in the future then where we move from, like if you think about technology companies in the past, like IBM, Microsoft kind of being those, the most influential companies, and now you have these upstarts like Silicon Valley, like Mark Zuckerberg in his dorm room. Could we have that in the future where it was these kind of Bitcoin people who have got in and created this technology could kind of be that influential at kind of Zuckerberg level?
A little bit. If you look at Ethereum, there's Vitalik Buterin, which is one of the core. Well, he's the inventor.
Well, he's like a 23-year-old guy from Toronto, isn't he?
Yeah, he's a young guy who studied at Waterloo.
Right. Yeah.
And obviously, a genius, but
Yeah.
he's one of the biggest community influencers.
Mhm.
So essentially, there's really this twofold influence. There's the miner influence who run the nodes, they're invested in the nodes, and then there's the development team influence. In the case of Vitalik and Ethereum, what's really interesting here is that team is trying to change the game, like really change it, right? We're talking about mining, and mining is this activity where you're trying to find the solution to a problem using enormous amounts of computer power. And this enormous amount of computer power today is enough to generate electricity for a small city. Okay.
So it was like a country
Maybe some countries.
shoveling a lot of coal into those things.
Exactly. So it's pretty scary when you think about it, right? Because from a sustainable standpoint, and I think James and I, we both agree here, proof of work, which is the mechanism used for signing, is not a very sustainable means to do it. So the Ethereum team is trying to achieve this thing called proof of stake, which would totally change the energy requirement for protecting the blockchain. So this is supposed to come within the next year or two, we don't know exactly, but it also changes the way the communities can be influenced, and you could become a node runner, right, at a much lower cost than it would take for you to be a proof of work node runner.
Right.
You don't have to buy this really specialized hardware and hope that maybe you're going to get a reward. In this case, the reward's going to depend on your investment in the chain, meaning how much Ethereum you hold. And basically, very basically, in a very high level, you're going to be collecting a type of interest on that money you hold in the network. And that money is what's protecting the rest of the network. So being invested and getting this interest will make you protect the network with everybody else.
Yeah.
I think that's going to change the game and who influences what's happening on the blockchain.
Right.
And it is that whole purpose of the blockchain was to remove the intermediaries and also to distribute power. Right now with these mining pools, that's a physical resource. It's a large factory full of processing power, and it's typically owned by someone. And that becomes power on the blockchain network. If you've got a certain amount of processing power and you own a huge pool, that translates to real power.
Yeah.
And so you can influence and make decisions and change the economics.
Yeah.
I view that as one type of power in Bitcoin on the blockchain. The other is like the economists and the technologists who are advancing things. They're very powerful and influential in terms of making things a little fair, making it a little more even, more efficient, reducing the amount of coal that's shoveled into these machines, reducing the concentration of power into these pools.
Wow. Yeah, and just I know you mentioned Ethereum a few times, but I don't think we really established what is it that made Ethereum like, okay, well, this is a serious invention.
So Ethereum, so Bitcoin. Let's start with Bitcoin. Bitcoin is a product of a white paper.
Yeah.
Right. The initial Satoshi Nakamoto white paper we talked about, that we've all read here. It's a good read if you guys haven't read it.
Yeah.
In my point of view, it put together all the technologies that existed already for a really long time in a very elegant way around this one protocol that worked for distributed electronic cash exchange, trustless distributed electronic cash exchange. So that was almost 8 years ago?
Yeah.
Now, 2-3 years ago, I think, Vitalik wrote his own paper. And
the yellow paper, right?
Yeah, called it the yellow paper. And as a sort of wink to the original one. And he took it from when Vitalik, or at least from what I've heard, when Vitalik looked at the white paper and sort of understood what Bitcoin was about, he realized Bitcoin is really just a repository for state, right? And when I say that is, it keeps a record of values that have changed about something. Those values generally are considered Bitcoin, or let's call it money for lack of a better word right now. But it your account is linked to a balance, and the state of that balance can change given a transaction that comes in. Well, Vitalik realized it's kind of how computers really work, right? Computers in general, computer programs are meant to maintain state about different, types of information components or concepts. So as James was suggesting earlier, a property record is such a piece of information or a concept, and that property record has a state, meaning property may belong to me at one point, and then later it may belong to James. So the change of state is a transaction. So changing the name or the owner of that property in that transaction and moving it to James means, and keeping a record of that state in the distributed ledger, just like you would keep the balance of an account in the distributed ledger, means you don't need a notary to keep that record and send it to the government. You have a repository that's open and accessible to everybody, where we all agree that transaction happens openly, makes this, or at least that's what Vitalik saw, makes this technology really tick. You don't need just to keep a money balance. You can now keep track of any record that needs to be truthful and agreed upon by a common group inside a blockchain. So Ethereum, its main purpose was to put in the technological components that would make this whole distributed computing really efficient. Maybe I'm not being completely fair to Bitcoin, because a lot of Bitcoin proponents say that Bitcoin has this more or less built in. But to be frank, the initial protocol for Bitcoin implemented this as a bit of an afterthought, and not as elegantly as the Ethereum team has done, at least in my point of view. It's a very personal one, obviously.
So could it come to the point when these heavyweight cryptocurrencies are in competition with each other, or is there a way they can be working in harmony, or do we just not know yet?
No, they definitely compete, because Litecoin, that's the one I'm currently mining, and by mining I mean I'm leasing mining equipment from somebody else, so I don't do any of the technology. I just
shovel coal.
Yeah, I hired someone else to shovel it for me. And that's easier to mine, and so you get more substantial rewards than having the equipment processing Bitcoin. And so I see that as becoming more popular for smaller transactions. I was looking at the rewards I was getting for mining Bitcoin came in the form of Bitcoins. And when I was looking at spending those on other things, the transaction fees were $5 per transaction. And it's like, that is ridiculous. The whole point of the removing the middleman was to reduce the fees. And if I can't do a transaction in Bitcoin without having huge fees incurred, it's just a no-go. All the huge corporations and people moving millions of dollars, $5 is nothing, because it's a set per transaction. So moving it into Litecoin means I can do smaller transactions and it's not costing me enough.
Right.
If I had $1 million in Bitcoin, that'd be a different issue, but
Wouldn't be an issue.
I don't mind that.
I guess we should, at some point, acknowledge why we're having this conversation. Two people in SAP Labs Canada, so fascinated with blockchain. Why are you, Hugo? You work in like supply chain software, right? Do you want to just give like a
Sure. Do a brief intro.
Yeah, what do you do?
So I'm a product owner for the integrated business planning team.
Right.
That's a supply chain management team here at SAP Labs Canada.
Yeah.
So my specialty is working on, let's say, foundation topics. I work on the technical topics in MVP and work on things like logging, user management, application jobs. And blockchain kind of came as a side interest to what I'm doing, although it readily applies to the domain I'm working in.
Yeah.
basically, SAP is a company where there's a lot of opportunities for us to grow and a lot of opportunities for us to explore our interests and to actually show initiative.
Mm-hmm.
And a couple of years ago, or a year and a half ago, there was this program that was put forward called the Entrepreneurship Program,
Right.
which aimed at identifying talent within SAP that could put forward projects that could be realized as, let's say, internal startups. And James, a friend called Fareed, and we decided to put together a project based on electronic cash. And it took the shape of an application that was there to solve the letter of credit problem in banking using blockchain technology.
And why do you call it a problem?
Well, the letters of credit are a really old financial instrument, very expensive, very slow to use. Banks already know that they're somewhat problematic because their customers, the traders, use them less and less. They rely on less secure forms of payment, which is like let's call it open account trading, whereby the individual traders or trading companies will directly exchange funds between themselves and their partners in trade. They do this based on trust because it's faster, it's cheaper, and essentially more efficient.
Right.
Now, what the trade-off of doing open account trading versus using a letter of credit is there's a drop in security or a drop in assurance that you're getting the payment for your goods. So what we were trying to do, which we partially achieved, was build a technology where you could secure the funds and you would have the same type of working conditions than you do with a letter of credit, but at a fraction of the cost and a multiplication of the speed.
Right.
And we did really good. We made it to the finals of the entrepreneurship contest. So this program takes the form of a sort of contest for
Right.
6 months, where we're all put through this internal program where we have mentors and people that help us build a business case, prototype, and then we pitched it.
Yeah.
It was a lot of fun. It was really exciting. And we got to talk to a few of these people, and the traders, their problem was that they have someone who wants an order, a shipment of spare ribs or something, in a shipping container, and this person wants like 5 or 6 shipping containers worth, and it's like, well, the cost of a letter of credit and the cost of the time, it's not worth it, but also the risk of sending 6 is too much, so I'll send you 1. And so it limits his business, that he doesn't want to take extra risks, so he wants to establish kind of a relationship with his trading partner. So he just sends 1 shipping container and then waits the month or so for it to get there, and then gets his payment, and it's like, okay, you paid me, I trust you, and then the next shipment, maybe I'll send 2 or 3, but not all 6.
Yeah.
And so being able to do that digitally instead of by paper, because that's some of the basis of these ships and some of the ports, is you have to have the physical document saying, yes, you're allowed to take this container. And digitizing that would make it so much more efficient, and you could sell that much quicker. So a piece of paper that gives you the right to a container of meat coming off a ship, there's other people selling and trading these, but if it was on the blockchain and could be traded electronically, it could be done so much faster and with fewer parties involved.
Right. Well, so how did you two and Fareed get working on this project then? Because you don't work in the same exact team, right?
So I kind of had the blockchain experience, a bit of a technological head,
Right.
I'm a bit of a techie. But I'll let James introduce himself. I went to him mostly because of his ideas on economics.
Right.
I was always fascinated by money, so there's a few principles of currency and trust that I was really interested in. And I had submitted an idea to the same program, and actually I submitted 3. I wanted to improve my odds. one of them was kind of accepted and made it a little further, but it didn't go very far. The one that dealt with money, I started talking to Hugo quite a bit about, and exchanging ideas on digital currency and what is behind money. It's trust. So I submitted that idea. It wasn't accepted. We started talking, and I joined Hugo's team for his project. And it was funny because we were neighbors at the time. Literally, I could look over the cubicle and there's Hugo. And so
a nice coincidence.
Yes. It was kind of the email exchange of, hey, you're also in this program, and it's like, well, wait, are you over there?
Yeah.
So the project was kind of on hold as I was helping out Hugo, and after the innovation program and the pitch and everything, we went back to our regular jobs for a while, but money still fascinated me, and all that I learned from Hugo on the blockchain and how it works and the technology behind it got me really interested in where is this value coming from behind the Bitcoin price, the Ethereum price, and exchanging value on a Ethereum contract by transferring the ownership of the rights to a container of cargo on a ship was really fascinating. And I thought, hey, you could have a currency based on something of value. And that's where the paper kind of started growing and expanding.
Yeah. So you're a user experience designer, right?
Yes. My first degree was in industrial design, so I was designing injection molding plastic for car dashboards and power tools and furniture and things like that. At the time I graduated, the internet was starting to become popular, and so most of the graduating class I was with all went into software design and interface design. It was a fascinating time to be involved in that, and I discovered usability and making things easy to use. So I went back to school to study psychology and how people think and work, and then I got a quick diploma in accounting, which is the weird one that everybody's like, okay, industrial design, yes, got that designer, and then psychology, okay, that's a little weird, but we understand the transfer of design and it's for people, so you need to understand people, but then accounting, that's a weird one. But I want to design better monetary systems, better accounting systems, and so I wanted to understand a little more about it. The inspiration for the paper, though, is economists are very, I'm generalizing here, but a lot of them think inside the box. There's certain lines they don't cross when they talk about economics, and hey, let's think outside the box, but they never cross certain lines. As a designer, I'm trained to think outside the box, cross all the lines, and come up with a lot of ideas to see where it could go. And so I think the paper was really interesting because the creative aspect of coming up with solutions to problems that are in the monetary system. So interest rate control is centralized. Inflation is very damaging to the economy, but it's very slow. It's like the problems with the environment. It's very slow and hard to see, so people ignore it. So, I was interested in addressing some of these core problems with monetary systems like inflation and interest rates. It's entirely different in digital currency because it's not centrally controlled by a government, but there's some crossover because coming up with a new country doesn't happen very often. So a new national currency is extremely rare. But a country can decide to just print more money. In digital currencies, it's very hard to print more money. Mining the blockchain is difficult. It requires a lot of energy, a lot of processing power. So getting a new digital coin in one currency is very difficult. But creating another cryptocurrency and another cryptocurrency is very easy. You just need to get the popularity going.
Right. So I understand now that there's kind of three areas: user experience, then psychology, then accounting. So, and you've obviously become fascinated with economics, right? And when you talk about your paper, we haven't referenced the fact that you're bringing out this white paper, The Future is Money, right? And I'm not going to be able to do a good job of kind of summarising what it's about. But the futures-backed currency is the idea, isn't it? Do you want to?
Yes. So a few of the lines that I cross in that paper that economists are really hesitant is backing money with something. That's like the gold standard. You mention that to an economist and they say, it doesn't work. We tried that, it's a failure. The 30s and 40s were a disaster because of the gold standard.
Right.
I went a little further in that, well, you can put a lot of things on the blockchain that are assets, but it's not a really good currency because you're storing something. You have security arrangement around the storage of that. And so you're going to be paying fees to protect gold. You're going to be paying fees to store wine in a cellar. You're going to be paying fees to keep the meat frozen in a locker.
Right.
If all of those assets were on the blockchain, storage is preventing use. Mm-hmm. So really, if you want to back a currency with assets, it should be things that are stored because you need to store them. So supply shocks, like there's oil tanker fields where they're storing oil for a country in case there's a problem and they don't get enough oil into the country. The refinery can just take some oil from the tanker farm. So there's a storage of oil there that is an asset that we need to store. So that could be on the blockchain and could be an asset-backed currency. But the next line is you can have currencies that are the factory. So all of the factories that are stock-based and producing objects or even offering services. Mm-hmm. These things are on an exchange and there's mutual funds that have a fairly stable value. You can put that on the blockchain and then you have another currency that is not storage of a physical asset like oil or gold. It's you own a factory, and so there's no fees for storage, and you might get a profit from these if it's a currency that's distributed electronically. The last line I crossed was the futures-backed currency, and that's a type of currency that you're backing with the future delivery of a product. And this is where, in monetary systems, you need to control the supply of money. And in a traditional monetary system, it's the government controlling it. Mm-hmm. In blockchain, it's the algorithm controlling it. If you created a currency that was futures-backed, it's a promise that I'm going to deliver some meat in a shipping container to this port, and that's a promise, and I can put it on the blockchain. That scales really quickly when people are confident and the economy's booming and the politics are stable. There's a lot more futures that people are willing to issue and accept. So the scale of the money supply can be accommodated to the people.
Right.
It's a bit of a line to cross at that first point of saying gold-backed currency, and a lot of economists are like, no, don't do it. But futures-backed, there's a lot of interesting effects. If you can get past that first line of backing a currency with something and start looking at the effects of a futures-backed currency, there's a lot of interesting things that happen with interest rates, inflation, and decentralized control of the power of money.
Mm-hmm. Wow. So is this kind of like a unique concept that you've kind of come up with, or have you been influenced by other ideas in economics?
I've been trying to read a lot of papers about money, but it's a very narrow subject area. And there's a lot of similar ideas out there, but with blockchain coming along, it could really mothball and roll. So there's similar things out there like prepaid cards.
Mhm.
Like you go into a coffee shop and you buy a prepaid card and you're exchanging money for this future of a coffee. But
Yeah.
it's not the same as something that's traded on a blockchain because you're not getting a discount for it. Or if you're getting a discount, it's fairly small. And you're also exchanging money for it. You're getting a prepaid card.
Yeah.
So some of it came out of discussions around the mesh networks. So mesh networks are where I have a cell phone and I'm transferring data from one cell phone to another to complete a call rather than going through a centralized control of cell phone towers.
Mm-hmm.
And in those kind of economies, you're trading your current access to my phone for me accessing your phone in the future. So it's accounting for that. I wanted to look into and say, well, how much effort if I'm not using my phone and other people are using it, where's the credit going? Like who's accounting for that and how can we make use of that? And that mothballed into the current paper. And it's been evolving over a couple of years now, but it just keeps growing and growing.
Yeah, and the idea in your mind from it keeps growing and growing. Were there points where you were thinking, kind of doubting yourself and the idea and thinking this is crazy?
Often, because I'm not a trained economist, but I've got that weird background that I'm originally a designer, so I don't think the same as economists. So I'm coming at it from the outside saying, hey, I think this is wrong. I don't think we're doing money correctly.
Right.
And I do think there's a similar, like cryptocurrencies are the same as these. They're just, the value is based on faith that someone else will want this as a currency, not as something behind it.
Right.
So if you have a backed currency, the value is based on someone wanting the thing behind the currency. And in cryptocurrency, it's currently...
there are things that are happening that actually kind of follow along the lines of James' thinking and James' white paper, which I find really fascinating because James came up with this, more than 2 years ago. But when I first heard about it, he presented the idea to me, and I was like, "Wow, this is great." And I was really just starting to get my head wrapped around, technologies like Ethereum. And when you're looking at the market today, you're looking at what's happening on these, let's say, distributed ledger technologies that have the ability to have smart contracts and do things like digitize assets or digitize, let's say, digitize assets. You're starting to see this. You're starting to see companies that are issuing tokens that represent real physical assets. So in the case of gold, this has happened already. In the case of oil,
Digits,
DGIX, Futures are not being issued yet.
Well, if you think about the letter of credit and the bill of lading, those are future money is what a letter of credit is, and the bill of lading is future stuff. It's just it hasn't reached the port yet, and when it reaches the port, then you get the money. So those are technically futures, and there's how many trillions of dollars in assets floating around in the ocean.
20 trillion or something like that.
And if you could convert that to a currency and say, well, if you don't want to own the stuff as it's floating on a boat all the way to the port, you can just put it into a blockchain and say, well, it's now going to be valued at a container load of pork in this port in 3 months. So that is a future.
So what's happening is exactly what James was describing. Technically, I think there's a lot of work that needs to be done, and James's thought process goes further than where we are right now, which is interesting. And I think there's going to be a worthwhile read because there's problems to solve around the digitization of futures and the balancing act you need to be able to maintain, and sort of this assignment, reassignment, this exchange of futures Because maybe I've got 200 chickens as futures in my pocket, but I might not want to eat chicken all week. So there's going to have to be this ability, for these currencies to allow you for a kind of fair trade across the futures, And we're not there yet, because when you're looking at Ethereum, the token are issued independently and without regards to a concept that would be common in exchanging their values.
Yeah.
But I think James is heading in the right direction to establish some.
And the paper's wrong. Like, it's an idea, and it's more of a futurist look at what could possibly happen.
Yeah.
And so there's economic concepts and ideas that are rough. So yeah, it's not an immediate future. It's a far future, like 10 years, 5 years if things really move rapidly.
Yeah.
But I'm thinking more 20 years, because these are huge changes in terms of countries controlling money, in terms of the technology coming along and advancements. So it's like a Jules Verne submarine thing.
Yeah.
They didn't exist when he wrote the book, but they came about later. It's just the ideas are there. We should start talking about this so that we can prepare for it.
We have something to work towards. We have an idea
Yes.
to work towards. It's not just an abstract set of
Yeah.
directionless movements or whatever. Yeah.
Yeah, and the problems I wanted to solve is value. Like, the value of Bitcoin is just going up and down and up and down and up and down, and you take a huge risk when you buy it. If you're doing a transaction over a month, and it's like, okay, well, I'm going to put my money into the blockchain and then I'm going to take it out and buy something here, you don't know if it's going to be double or half. It's very risky. Whereas also in cash, you've got inflation, and so fixed income retirement, fees that don't change because they're legislated. Like, the deposit on a bottle is 25 cents. It hasn't changed since the 70s or 80s. And so the value of that bottle deposit is just plummeting, because nobody's going to change the legislation, and the motivation to return that bottle is decreasing over time, because inflation is just eating away at the value. That same thing happens to retirement savings. The price of a car in the 70s versus today, like, how does that damage people and the economy, and bubbles and all of these problems? These are things we should look at in terms of how can money be fixed.
Right. So who reads this paper then, and then what do they do with it? What do they do when those ideas are in their head?
Economists are quite common compared to monetary policy economists. Like, if you're dealing with monetary policy, it's the central bank and the commercial banks, and there's so many varieties of economists that the one I'm really interested in reading this are monetary policy economists, so central bankers.
Right.
But I really think I'm hoping everybody reads it, because if you, like, in usability and design, we talk about our user group, and my user group is, have you used money? Then you're my user, and you've got a problem with this, we should talk about it and see how does money affect you. So I've got a very narrow focus on the paper, but I think more and more people should read it. So people interested in blockchain and Ethereum, digital ledger technology, economists.
Yeah. And that's an interesting, raising an interesting question for me, is that how will people, like the regular person like me, need to change my understanding of what money is, or can I just carry on living the way I'm living and just...
No. I go into a section in the paper about when you create a future-backed currency, interest is embedded in the money itself. Yeah, there's quite a bit to read before that becomes clear, but with money that generates its own interest, it's decentralized from the bank. But then how do you get a physical note? Because this costs money to print. It costs money to prevent forgeries. So if I wanted to have cash in my wallet because this whole futures-backed currency thing, I don't understand it, I don't want to deal with it, just give me a bill.
Right.
A company can create that and say, okay, we're going to take a digital currency and print a bunch of money and say, if you bring this to us, we will issue the digital currency and tax it. And so you can have digital currency backing physical currency. And I think that happens right now where people print out the codes on a piece of paper, and you can validate that it's got currency on it, and you can transfer it to yourself. But if it's exchanging futures-backed currencies, it's still possible with a physical bill. And for people, it would eliminate the charges on a checking account.
Right.
Because you keep your money in a checking account because you want it secure, but you're not getting a very good interest rate and you're getting all these fees. In theory, this new monetary system could create an easier way for people to just hold on to their money, and it won't be gradually shrunk by checking account fees and inflation shrinking it.
Wow. Yeah, and there's a lot in this paper. It's a 44-page white paper, isn't it? And there is a synopsis that you've said is geared more towards economists who will all already understand kind of, a lot of the basic frameworks of economics, and they just want to see the idea. And then the full paper is for people, okay, this is the top line, you've got to understand all this stuff, and then you can read the idea.
Yeah, it's going to be difficult because everybody wants to read less, and so the short paper, there's no diagrams and there's no explanation of the theory, basic monetary theory. So the 6 pages covers the whole thing rather quickly. If you're a monetary economist, you can get through it. The longer paper kind of explains, this is what money is, this is what interest is, this is what inflation is, and here's how we can fix it.
Yeah.
And there's some diagrams in there to kind of explain how interest can be embedded in money itself. Hopefully it's readable, but again, it's the first version, and it's just getting out there so people can start discussing it.
Right, so you see this as something that you're going to continue to work on after release?
I hope so, unless someone says, no, it's entirely wrong, and they can prove that it's entirely wrong.
Okay, so it would take someone to come along, and someone obviously you respect their opinion, right?
Yeah, I'd love to get this discussed in central banking circles as an option or a theory. I think they operate at a different level than me. I'm more creative. I'm looking at crazy ideas. This is a crazy idea that may come out in 10, 25 years.
Right.
Should we prepare for it? What do you guys think? Can we run an experiment to test any of this? Is there data out there on digitized letter of credit or digitized bill of lading that can show that these futures actually generate interest naturally? So I'm sure there's some type of analysis that some economists can create some models and say, yes, it works, or no, it doesn't, but I don't have the background to do that.
Yeah.
I'm hoping somebody else can look at it and say, we should look at this area.
Right.
So I'm thinking like 90% of the paper is wrong, but the 10% that is right, I'm hoping adds something.
It's important, yeah. What do you think, Hugo?
I think James is heading generally right direction. Like from my point of view, the paper that I read and the discussions we had are being echoed in the industry. So as I was trying to mention earlier, the tokenization on DLT technology allows for digitization and is the first step towards that type of economy. I think there needs to be a big conscious awakening in these circles. So whether it be Ethereum or any other DLT technology, we have to be looking at solving problems for the everyday man, right? And interest rates, inflation, and control over currency is something that we're all sort of trying to wrap our heads around. And right now it's hard. I think it's very hard to see, even for the technologists and the theorists in the cryptocurrency world, that's the problem we're trying to solve, because there's so many things that we're looking at the same time.
Yeah.
Right.
It's very overwhelming, isn't it?
Yeah, it's really overwhelming, and it takes a while to once you're comfortable with the technology, you understand it, and you're not asking yourself these fundamental questions anymore about whether it works or not. You've passed that point, and then you have to think what really is happening on these technologies, because there's new things every day, right? Tokenization, moving from proof of work to proof of stake, and these things that are cryptic. I'm saying them half the people who are going to watch this video don't understand what I just said. But that is fundamental to cryptocurrency. And then here James comes along and says, okay, guys, but don't forget, we're trying to solve these other bigger problems that go way beyond cryptocurrency. Yeah. And maybe your technology, maybe this technology can help, but it's not the only thing that we need to think about in order to solve the problem. And that's where James' paper comes in, and James's ideas could be really taken up by the community if a few central bankers come along and say, you know what, there's merit to this stuff, and we should be really considering how to include mechanisms in the technology to support these ideas.
Right. The other thing is, I don't want to get too conspiratorial, but do you think there's a big, do you think there's a lot of people working in central banking who kind of don't want to hear these ideas because it's, they just want to see out and get to retirement age, and they don't deal with this kind of stuff?
Oh, there's always resistance to change. If you want to make enemies change something.
Yeah.
But there's no conspiracy. People just do their job and go home at the end of the day. I think central banks are concerned about any change that would impact things too rapidly. Because rapid change is dangerous, and a lot of people could get hurt, a lot of money could disappear, a lot of things could go haywire. So central banks are very conservative. It's like, how can we keep things stable and keep things moving along without giving off the wrong signals? Like central banks, they say one wrong word in a statement and people kind of go, whoa, what's going on? So any statement about future interest rate changes is very measured and very exact as to what they're saying. I don't think central banks would make a great announcement saying, this paper is really interesting, we should move to this direction, because the financial markets would say, what? So this is kind of an innovation thing that behind the scenes everybody's going to be looking at it. The same with the R3 and the Jasper project. They're experimenting. They want to see what's involved. And the Jasper project, or Project Jasper, whichever term, it was interesting to see how exact they were in terms of their analysis of how can we use this technology, how much is it going to cost us in terms of the equipment to run, how much is it going to give us in terms of security. And that's where the 6 blocks before we can secure a transaction is not going to cut it with a central bank that's moving a huge currency and wants certainty.
Wow.
There are some central bankers that think it's great. I think there's some central bankers that think it's not that great. I agree that they're being very careful on both sides on how they move with regards to technology. And they're being slow purposefully because they are all traditionally very conservative, and they're all, regardless of which side they sit on, worried about fast-paced change. I think the big concern that I'm starting to see in the industry, at least from my perspective of a participant, is that now there's worry about how the consumer might be negatively impacted. 2 years ago, bankers were saying, okay, you buy Bitcoin, it's your problem, we don't care. The economy wasn't sizable enough for them to be worried about the consumers. But now that there's an understanding that, just about everybody and anybody can now invest money, sizable amounts of money, into cryptocurrencies, they're worried about, for consumers, what may happen if somebody loses $1 million, and if they lose their life savings, the regulation and controls around trading in general are there to protect consumers. My point of view is I think what we're beginning to see is genuine concern for economic stability in this area because the economy is becoming so big in that area.
Yeah. Yeah.
Yeah, there was, that's really a bad thing to say. Well, I'll say it, no. There was before the dirty 30s crash in the market, there was some Rockefeller in an elevator, and the bellboy who was controlling the elevator was talking about the stocks he invested in. And that's when they said, okay, I got to get out of the market now because everybody's in the stock market, including the bellboy.
Wow.
So it is concerning when there's the uncontrolled investment in risk by everyone. As an investor, you should look at, okay, 10% should be in risky things, new ventures, investment in inventions and research and development. So 10% of your portfolio should be off in that way. If the general public is feeling that Bitcoin is where it's at and you can triple the value of your money in a month, and everybody jumps in, that's not really going to happen because there's nothing behind it. If everybody triples the value of their money, nothing's going to change because there's no new cars, there's no new buildings, there's no new roads. We just changed a number and put a 0 at the end, so everybody feels, well, everything's done great, and then everybody realizes, wait, now I have to pay 10 times as much for a car. What's going on?
Yeah, that's really interesting. And another thing that you kind of made me think of when you were talking before, Hugo, was do you know this Andreas Antonopoulos guy? He's quite outspoken. Have you heard of him? He talks a lot about Bitcoin. He was he was talking. I think his main reason why he wants blockchain is because he thinks that an extra like 2 billion people could enter the banking system if we had something like blockchain, because it's so much more
Certainly unbanked.
Do you think that's one of the main reasons why we should?
Well, blockchain technology is definitely an enabling technology, and when we did our entrepreneurship, there was this really interesting discussion about how when you go to some underdeveloped countries, you'll find that the cell phone usage for lots of activities is much higher than what you'd find in countries such as Canada, developed countries. And the reason for this is the barrier to entry for the new technologies is much lower. So it's easier to sell cell phones to people in a country where no lines were laid for telephones than it is to set the lines up and then put traditional phones back in. So essentially what's happening in certain countries, the populations are frog leaping over technological advancements into technologies that are easier to access. Blockchain kind of resembles that, right? It would be super easy to become a blockchain bank. Like basically set up a shop with a little, counter anywhere, and somebody comes, gives you a chicken, you give them a private key or a little USB stick that hardware wallet, and you say, okay, I give you your Bitcoin here. You can verify it on any computer that's available or even on your phone. Then it would be to set up a real bank where you need your own information systems, you set up your ledgers, you have your website, you have your electronic banking website, you manage all this infrastructure individually. So blockchain technology would actually make it super simple to provide banking for the underbanked. I mean, what's happening in countries where the economies right now are unstable is companies are drop shipping Bitcoin ATMs. People are going in, like countries like Greece or other economically unstable areas, and saying, all right, the government's going to lock you, it's going to freeze your account. Before they freeze your account, move your money to crypto, and here you go, right?
Wow.
Now, here we're talking about borderline legal activity and very disrupting in governmental terms. But from my point of view, it just says, hey, it's so easy to move your assets to something that we all recognize right now. James has some real concerns and some very good points about where in how the value gets agglomerated in these cryptocurrencies. But for me, the technology itself is really worthwhile, and where I see value, it's not in this currency being backed at the moment, for the moment. It's more in this currency's ability to be used as a trading mechanism. So obviously, all currency eventually becomes backed, right?
Mm-hmm.
I'll pay you money for work you'll do for me.
Yeah.
So it's backed by a service. But the currency, as you see it, like Bitcoin or Ethereum, is more or less backed by its usage. Ethereum is more interesting, I think, and it corresponds more to James' point of view, because intrinsically the whole way Ethereum works is that the underlying distributed computer uses the currency to drive activity.
Right.
So it becomes more like an asset. Okay, so if you're running programs on Ethereum, it's charging money all the time. So there's a movement of the currency that's constant, and which corresponds a little bit more to what James is looking for in the currency.
Yeah, when bringing people banking the unbanked, one of the problems is having a large bill and splitting it up, and that's where the unbanked, it's like the smaller transactions, the 12 cents for this or a penny for this, and transactions that are too small for big banks to do. And having physical currency makes it really difficult to cut a bill in half and give half to you and half to you. So digitizing it, but also making it micro, is where Bitcoin can be split into the individual Satoshi units, which are a millionth of a Bitcoin. It's still, the transaction fee is problematic because it's too huge to actually transact at a single Satoshi, which I think is getting towards less than a hundredth of a penny. But in some economies, that's important. I want a chewing gum. I'm definitely not going to process that on blockchain. But if we want to bank the unbanked, that's where we should go. So making sure that the efficiency of the system is there, so proof of stake rather than proof of work, and making sure that the transaction fees are low enough that it can be accessed by the people. That's where I was mining Litecoin rather than Bitcoin, because Bitcoin, it's just too expensive for me to get my money out of Bitcoin into something else. Whereas Litecoin, it's cheap. I can buy pizza with it without paying $5 for the transaction.
Right, and I think you've both done a really good job there of kind of unpacking and explaining how that can work. I mean, I understand that, but it's then making it happen, right, is the other thing. And another interesting point that this Andreas Antonopoulos guy made that I want to bring up is, so the way that the media has got, media consumption on the internet now, is Facebook, YouTube, Google, they are the platforms. But they would be nothing without the content producers. But the content producers don't get the money. Well, they do get a little bit of money, but then Facebook now has tens of billions of dollars, right? So there's a kind of disparity of fairness there. And I think what a theory is that if all this was kind of hosted on the blockchain and there's cryptocurrencies, that the producers could have these like micro sums, and there could be a system that works in such a way that, if you watch a YouTube video, you pay 0.001 or whatever. Or if you think about like how Netflix works, instead of having a monthly subscription, you could have like you can pay like 10 cents to watch an episode or something like that, and it just kind of distributes the wealth a little bit more.
It's peer-to-peer trading, and it's peer-to-peer transaction. Meaning, I'll give you an example. There's a really nice freelancer app called Etlance,
right?
Which I think is fantastic as an example of something that's real world. If you've used other applications for freelancing, you go take a look at Etlance, and you'll realize it's an application that allows you to ask for projects or post projects, pay a freelancer, or get paid as a freelancer.
Right.
There's no intermediate. There's no intermediary. Nobody taking 10% of your project fee because they have the server. The whole application is hosted on the Ethereum blockchain. The transaction fees you're paying to Ethereum miners to secure the state change. So it's only between you and whoever's posting the job. There's nothing that goes to anybody else.
Right.
The rest of the money is because you need to pay transaction fees on the Ethereum network, and these transaction fees go to the miners right now.
Right.
And eventually will be used as interest for you if you're running a node. And there's,
Well, that just goes to show how the whole concept of work and working for a company could just be completely transformed. And, I mean, the implication is there for everything, really, isn't it?
Yeah.
It does remove the original intent of money, which was I want chickens. He's got tomatoes, but he doesn't want my fruit. I've got oranges, so we need to find someone who's accepting oranges in exchange for tomatoes, so I can get the chicken. That whole chain of trades that needs to happen. That in a physical sense, 100 years ago, money solved that problem. It's like I sell my stuff for money, and then I go to you and say, "Here's money, give me the chickens." But with the blockchain, all those chain of trades can be happening in the background without money behind it anymore. Like my tomatoes are changed for oranges, are changed for chickens, and then everybody's happy.
Yeah.
And so on these social networks where people are liking something first and getting a reward, but then using that reward to watch other entertainment. That's the same concept. It's removing money from the coincidence of wants. So I want this, I've got this, do you want to do a trade? And finding someone else to do that chain of trades to get the economy moving.
Wow. Yeah, some very interesting stuff. And another thing I wanted to address in this video is people are talking about blockchain now. There's a lot of hype surrounding it. They're calling it hype, right? And there is hype, but obviously, if you listen to this conversation, you know that there's a reason for that hype. It's just a case of how do we get to that point where all these things are a reality. But do you think there's a lot of people, like marketers, talking about blockchain in a way that doesn't really help, like that, hyping it the wrong way, or?
Well, that happened when the internet came out. I mean, people were hyping it, and they were thinking it was going to be in the kitchen, that people would be able to share recipes and figure out how to make this recipe into feeding 12 people instead of 7, and doing all the math that way. So you could do that on the internet, and it'd be great. The internet's gone a completely different direction from that.
Yeah.
And when the internet came out and people were hyping it, it's like, this will be great for everything. And it's been good for a lot of things, but it's been bad for some things too. So there's always hype.
Yeah, because there could be bad things happen with blockchain, right?
Oh, yeah.
Absolutely.
I think in terms of hyper marketing, there's a bit more maturity, I find, in the space. So there was maybe really at the beginning, 2010 to 2012, a lot of hype when the first crash happened, and a lot of people got burned, right? So for those who don't remember, Bitcoin initially went up to, if I remember correctly, around 1,400 USD and crashed back down to 200. Lost a lot of people a lot of money, and it stayed stable for a number of years. Now we know today the worth of Bitcoin is much higher than that, and things have restabilized. But I find that in the marketing space, so whoever's talking about cryptocurrency, there's more maturity about how things are explained, right, and talked about, and also more maturity about how people read the news. And it's as events happens, as these things unfold, right? It's new technology. It's a brand new world. You're walking on a new planet. When you start buying cryptocurrency and you're using it, you're not in the traditional money space. It's a new way of thinking of things. If you go to a Bitcoin ATM, you buy Bitcoin today, it's not going to work the same way than when you go to the bank and you withdraw money. It's totally different. And it takes some getting used to. You have to be ready to be in this new world. And I think that as things happen, forks, or as new cryptocurrencies appear, as digital or distributed autonomous organizations, DAOs, get created, and people invest in them, and these initial token offerings happen, and accidents happen, like the initial DAO, or exchanges close. We start getting used to how this economy or this community works.
Yeah.
We're less afraid. We're more mature about the information that gets posted.
Mm-hmm.
Now, first time when the Dow crashed, everybody thought it was the end of the world for Ethereum. Oh, it's the end. And now it went from $40 down to I think $7 in terms of worth. The base currency Ethereum. And then for a long time, people were debating whether or not this type of activity on Ethereum was safe, if we should trust it. Well, the fact is, the creators of Ethereum had said this is a very highly experimental space. Whoever invested in Ethereum at that time was speculating and was hoping things would go the right way. It's another planet. You never know what's going to hit you. And I think that as we grow and as we experiment, as we explore, it's becoming more familiar. And this hype that you're talking about, or that may exist or not, is becoming less and less influential. People are understanding how things work.
Yeah, but probably before people were kind of playing on the fact that no one understood it, what it was, or what it was for.
Exactly.
So you could just say, "Oh, this is this amazing new thing."
Put your money here and cross your fingers. There's still a lot of speculation.
Yeah.
So you can go to the mainstream sites. You can go to Reddit. There's a Ethereum trading space called F-Trader.
Right.
You can use Slack. You can go to various other sites where these news aggregators provide you with information. You'll see there's a lot of hype, a lot of talk. And some of the investors aren't necessarily super technologically savvy. So you'll have a bit of everything.
Yeah, there was a senior finance guy who said something that any of my people who invest in this are going to be fired because it's a pyramid scheme.
Well, that was the CEO of JP Morgan.
Yeah.
And why do you think he did that?
I think just not okay, maybe he's got a solid understanding of it, but there's the opinion on how it's going to move forward. As a pyramid scheme, like corporations are pyramid schemes because if you're an early investor, you make more than later investors. So that's a vague pyramid scheme. But
I think that statement was made in a given context. If I remember correctly, I'll quote what I remember reading. He said that he was talking to his daughter about it. And that his daughter had invested in cryptocurrency and made a lot of money. And she was trying to explain the worth of the cryptocurrency. And he came out with a statement that he thought it was worthless, that essentially the technology was some type of pyramid scheme and there's no value. There are two, I'm looking at this from 2 points of view. First of all, JP Morgan is part of the establishment, right, and has a vested interest in the current way banking is done. So as let's say a central banker or as a higher ranked member of the banking community, I might tend to be conservative and say something like, don't use something that's highly experimental to move money around. It's probably not a good idea.
Yeah.
Which is, it's true, right?
Yeah.
Fact is, right now, you shouldn't run your whole company on Bitcoin, or unless you're an exchange, then not what you do. But if you're a bricks and mortar shop and you're selling your small dep or a small shop down the street, you might not want to say, I'll stop accepting cash and I'll only take Bitcoin. That's true. However, I think there's also this notion that there's a lack of maybe understanding of what's underlying in the distributed ledger technology, and there's a place for maturing. For JP Morgan, maybe they should take some more time, because as funny as it may sound, JP Morgan's a member of the R3 and other consortiums that do blockchain development. So saying that the technology is worthless is a bit of a funny statement.
It was,
right? Yes, as the participants in the whole development.
Yeah.
But
and people make statements all the time about statement about the size of computers will be much smaller in the future.
Yeah.
They'll be the size of a house rather than.
Yeah.
No one's correct in predicting the future.
Yeah, absolutely. But I guess we won't go for too much longer. But I wanted to ask you about what's next for you guys. I know you're going to carry on working on your ideas, but I know you do some stuff working in a community. So you did this fintech formathon here in Montreal, didn't you? What was that?
So I'm part of a university committee in Montreal, and what we do in the university committee at SAP Labs Montreal is we support community endeavors that are related to academics.
Right.
And this group came up to us and wanted to set up an education workshop around blockchain technology, namely writing contracts on Ethereum. So we set that up, built up some groups, they developed some projects, and we supported them until the end. And there was a number of really interesting projects that came out of it. And I think from my point of view, the goal is to ensure that as myself, as an employee of SAP and as a community member at large, that people understand the implications of using this technology, understand the value, and that the startup community and the academic community is looking at this in a way that allows it to evolve in the right direction. So the formathon for me was an exercise in doing that, and I continue participating in these types of events. For me, the future is to continue working at SAP, promoting blockchain technology, but also working, on personal projects using technology. Right now, I'm looking at how the technology could be used to support organizations that do humanitarian work and humanitarian projects, and how to finance these projects in a way that's meaningful and sustainable. So, I think.
Yeah, I have a huge interest in that area. It's got to be effective and where to volunteer your time. The blockchain initiatives at SAP are taking off, so there's quite a few groups doing different things. There's putting your transcripts on the blockchain. So
Is that the True Rec thing?
The True Rec, yes. But there's other initiatives out there like voting.
Yeah.
Like voting on blockchain as a way of certifying a vote. Ensuring fairness.
Are you referring to the prototype they did in that Italian province? I think that's out there, isn't it?
Yeah. So it's not money. It's power. It's voting power. And ensuring that the people's voting power can't be interfered with. So it's definitely another area for the blockchain that I'd be interested in working on.
Wow. Yeah. You reminded me about something. You mentioned smart contracts. That's something we haven't talked about. I read something the other day saying a smart contract is not smart and it's not a contract. It's just a bit of code. Is that right or not?
Yeah. Essentially, that's an accurate statement. However, what's a contract?
Yeah.
Right. It's a formal language that's meant to express state.
Right.
Unfortunately, that's what code is. So whether you say contract or whether you say class in terms of code, for me, they're synonyms.
Yeah.
Okay. Now, maybe for a lawyer who doesn't know how to code, he may tend to say, no, it's not the same thing, because he imagines code as something that makes a machine do something. But a contract is something that expresses a state. You own something, you shall do something, you owe somebody something, right? It's in the state, there's a set of conditions that need to be rendered for it to be valid, and there's an arbiter that will say, yes, the conditions are met, then you need to give Hugo this amount of money.
Right.
A smart contract is a piece of code that essentially allows you to enumerate these conditions into a program and to have the blockchain evaluate whether or not these conditions are met based on your decision on how these evaluations are done. And if that's okay and if that's met, then the contract is rendered. Essentially, the money that you would owe me would come to me from your account. The beauty of a smart contract on a DLT which supports them is that it reduces the need for human intervention, and it can allow for automated transfers of money or currency. So if you're transferring to me Ethereum or other tokens, you can pass them through this little program, and the conditions that are enumerated in the smart contract, if they're met, that money will come directly to me, or will be refunded if the conditions are met. So smart contracts are just little programs, but that allow you to create a frame that's very similar to what a legal contract would be, and so that the network can support you in executing the set of conditions for a given transaction.
Right. So these smart contracts, this is an important development as well, alongside blockchain.
Yeah, it's a fundamental piece of what Ethereum brings. And when I said earlier that Ethereum is essentially a distributed computer, the distributed pieces of code are smart contracts. Anything you push onto the Ethereum blockchain is called a smart contract.
Right.
There are a few really interesting technological advancements on this DLT. There's the notion of smart contract, this virtual machine that's attached to all the nodes. Then there's a notion of distributed storage, which is a thing called Swarm, which will allow you to push the data that you want to store and make accessible to everybody onto a common sort of file system where people will be paid for storing, and there's going to be an incentivized storage mechanism and a communication protocol that's on top of all of that. So Ethereum is really kind of Bitcoin plus with tools to make it the new generation Web 3.0 or whatever we want to call it.
Cool. Nice. Anything else, guys? We've covered quite a lot here, haven't we?
We did.
My brain's getting tired.
Oh, we could go for days.
Yeah.
We could.
Yeah.
We did.
Yeah.
Thank you for having us.
That was a good conversation, and obviously the main reason I came out here is because we're putting your white paper out. So we wanted to talk about that a little bit. The future is money. I'll put a link in the YouTube description. Well, the synopsis and the full paper. And Hugo, great to meet you as well. And hopefully we'll see some supply chain white paper or something in the future.
Maybe one day.
Yeah. But yeah, thanks very much, guys. Appreciate it.